Dear students, welcome back. I gave this question to all of you to think and to plan. No matter it takes time, no matter it is taking time in planning, no matter you are feeling difficulty at this stage, but it is good to feel the difficulty at this stage rather than feeling the difficulty on the exam day. Okay? I hope that everyone is attempting this question. Everyone is planning this question. Is it? Am I right in my contention? Dear students? Okay. So, I want you to go through this properly. You can take a bit more time, no worries. We can, but try to attempt all requirements on your own. Try to at least plan or try to think for the answers on your own. We will then jointly discuss it because we are having prayers time here in Karachi. So I would request your leave for further 10 minutes or so that I can offer the prayers. And till that time, you get additional 10 minutes, 10-15 minutes. So draft it on your own, plan it on your own. Okay? Plan it on your own. Try to think on your own, and then we will see that how we will be taking this question along. Okay? So today we will target to address two questions of 50 marks. One is this and one another question. So plan it on your own, try to do it on your own, and we will be back in 10-15 minutes. I'll resume after the prayers break. Okay? Dear students, welcome back. I hope you enjoyed attempting this question. So let's start our discussion. Let's start the discussion of day 3 of AAA revision series. Okay? And we are starting our proceedings from this question number 1, which we have been attempting for some time. And you might have planned it on your own. Okay? The key to the success in any answer is strong planning. You have to read the answer well, and then you have to plan it well. Okay? So on your screens is a pre-December 2024 mock exam. Obviously, this is the most relevant exam for your preparation. Therefore, I have chosen this for your practice. Okay. Sorry. So I have converted this exam question in PDF document format so that we can easily refer this document. Okay. So this is question number 1 in front of your screens. I hope you can see my screens. I would really appreciate if you can confirm me as well. I would really appreciate if you can confirm me on the chat box. Great. Okay. So this is the typical exam pattern question in which you have multiple exhibits appearing on the left hand side. Partner's email, company information, meeting notes, interim inventory count extract, sustainability reporting. All these requirements cumulates 50 marks for you. This is the exam screen. Okay, this is the exam screen. This is the actual interface of your CB exam. So I have converted all these extract into PDF so that I can read easily. So let's start reading the question. It is 1st of July 20x5. It is 1st of July 20x5. This date is particularly important because it tells you that at which stage you are standing. And question number 1 is always usually uh, given the planning phase. Okay. See, year end is 30th September 20x5 and you are standing on 1st of July 20x5. So basically this is the planning stage and you are planning for the upcoming audit. You are a manager in the audit department of the Home Associates, a firm of chartered certified accountants responsible for the audit of Calibri Co. Calibri Co is a family-owned, non-listed entity. This is important information, which operates car sales and servicing locations under franchise agreement with car manufacturer. It's a non-listed company, so at the moment, we can think that the corporate governance requirements and strict ethical requirements are not applicable on the group because it's a non-listed company. Okay. The following exhibits available on the left-hand side of the screen provide information relevant to the question. So these are the exhibits available for your perusal. Partners email, company information, meeting notes, interim inventory count extract, sustainability reporting related information. It will always be the case that exhibit 1 will be partners email. Okay. Exhibit 1 will be the partners email. And in that email, you will find your requirements. Okay. So all the requirements will be in that email, then company information, meeting notes, and then interim inventory count, sustainability reporting. We can look at it one by one. The information should be used to answer the question requirement with the chosen response option. I know that. Okay. So audit manager has been addressed. An audit engagement partner, Gil Sands, is writing email. And what's the purpose? This is exhibit 1, and obviously you can see here, this is exhibit 1. Sorry, yeah. Are you getting this? I've converted into PDF. Okay. So audit manager Gil Sands. Audit manager has been addressed from the partner Gil Sands, and this email is in relation to the audit planning. In relation to the audit planning for Calibri Co. Date is 1st of July 20x5. Hello, you need to start planning the audit of Calibri Co for the year ending 30th September 20x5, and to help with this, I provided you with some relevant information. I met with the finance director yesterday to discuss a number of matters, including some recent business developments. In line with the internal quality procedures of the Home Associates, I have determined that PBT should be the basis for the calculation of materiality. Now, that's very important information for you. Using the information provided, I require you to prepare briefing notes for my own use in which you evaluate significant business risks, to be considered in the audit planning in Calibri Co. And this is of 10 marks. Then, using exhibits 2 and 3 only, so you do not have to use other exhibits. That's cool. So using 2 and 3 exhibits only, evaluate and prioritize the significant risk of material misstatements to be considered in developing the audit strategy and audit plan. Okay. So identifying risk of material misstatement and then prioritizing it in the order of importance. So you can also draft in the order of importance, or else you can also uh, list those down in conclusion in the order of priority. Both are the options available to you. Then by using Exhibit 4, you have to justify why the inventories of parts and pre-used cars have been identified as significant risk of material misstatement. Okay. And you have to justify why the inventories of you have to also design the principal audit procedures to be performed on the valuation of the used car inventory. Using Exhibit 5, discuss the so again, both of these are typical exam standard question. Using Exhibit 5, discuss the ethical and professional issues arising from the director's request to provide the systems and KPIs for sustainability reporting, including providing the sustainability assurance service. Determine which of these services, if any, could be provided by the Homa Associates. So basically, this relates to ethics and acceptance of non-audit service. So we can skip reading Exhibit 4, we can skip reading Exhibit 5 for these two requirements. In fact, this needs to consider all exhibits, but most of the business risks will be contained in 2 and 3. Okay, so now let us read the content and let us plan the answers. So our first focus should be on business risks and risks of material misstatements. Okay. So Calibri Co is a family business. Okay. So what you can do when you are planning an answer, you can start your word processor. And you can make a short table like this. Business risks and risks of material misstatements. There is a possibility that business risks may indicate the risk of material misstatement as well. Okay. So Calibri Co is a family business which was incorporated 30 years ago. Trades under a franchise agreement with a single manufacturer. Okay. Single manufacturer, Perpetua Cars Co. in 8 locations. All these locations are in the same country as the manufacturer, so there are no foreign currency transactions. The business comprises of 2 divisions. Without moving on further, I've not read before we are moving further, before we are reading further, can we say that franchise arrangement with a single manufacturer creates excess dependency on that manufacturer? Isn't it? Excess dependency. So we can simply say excess dependency. if the agreement is terminated, significant hindrances in business operations impacting profitability or even sales. So this is how we can think as we move on. Car sales are made from showrooms as part of the dealership franchise package with Perpetua cars. Okay. Calibri is permitted to sell new Perpetua cars vehicles from the manufacturer in that specific territory under the franchise agreement. So what is happening? Car sales are made from the showrooms as part of this dealership franchise package in the 8 locations. Are you getting this? Calibri Co. is permitted to sell new Perpetua cars vehicles from the manufacturer in that specific territory under the franchise agreement. The agreement requires single upfront fee of $800,000 for each showroom location. This gives Calibri Co. the right to sell the vehicles manufactured by Perpetua Cars Co. and make repairs to pre-used cars using manufacturer-approved parts. This fee is non-refundable and paid only once upon opening of each new showroom. Okay. So what is happening here? They have to pay upfront fee of $800,000 for each showroom location. Okay, let me once again see the company which we are talking about. Okay, we are talking about Calibri Co. Okay, so once this franchise agreement is done and once this amount is paid for each location, then Calibri Co. Okay, obviously this fee has to be paid to the franchisor under the franchise agreement to Perpetua Cars, and then they have the right to sell the vehicles manufactured by the Perpetua Cars. So this fee is non-refundable and paid only once upon the opening of each new showroom location. Okay, so don't you think that this is a big fee? Isn't it? This franchise fee is very significant. And this significant franchise fee will impact on your cash flows. Because if $800,000 is paid for each location, won't it be a burden on your cash flows? Isn't it? Plus, don't you think that this franchise fee obviously will go in, obviously it will be recognized. If this franchise fee under the franchise agreement, if this is an intangible, so this needs to be amortized. It might need to be impaired. Obviously, this is an expense, and this will eventually turn into expense. And it will eventually, over the period of time, This will impact my profitability. Such a high cost. This is a cost. Even if it is not going upfront into P&L, but it will slowly and gradually will enter into the P&L for sure. Are you getting this? So, we have to identify the impact on cash flows and profitability. Can we do that? Simple. I have explained it to you. So you have to identify this. Is this crystal clear to you? For business risk, I have explained it to you. I do not have to write each and everything. As far as the drafting is concerned, as far as thinking patterns are concerned, I have already drafted something so that it can save our time. Okay? Is this crystal clear? Plus, this is a business risk from this piece of information. We can also say that there could be a financial risk of material misstatement. We haven't read the content yet, what is to come next. But can we simply say that if this is an upfront fee, significant fee for each location, so if this meets the criteria of an intangible asset, it needs to be recognized as an intangible asset. Are you getting this? And if it's an intangible asset, and if there could be any indicators of impairment, we need to test this for impairment. Are you getting this? What is the useful life? Does it have any useful life? So we have to bring in our knowledge of IAS 38, intangible assets. Are you getting this? Franchise agreement lasts 10 years and can be withdrawn without refund if franchise conditions are not met. This is an important information. So as we are moving on, we are getting to know more things. So obviously we are doing all these things at the planning stage. So whatever I'm writing here, basically you're writing here. Oh, sorry. And if about the risk of material misstatement, are you getting this? As you read the next para, you get more information on this point. And what is that? Franchise agreement. 10 years. 10 years of franchise agreement. Duration, you know the duration. So you can amortize it. So this is how you are going to progress. You have to keep reading the information and you have to keep adding the data into your pointers so that your information is complete, and when you're going to draft the risk properly, all these pointers will help you out in drafting your answer. You will not get all the information relating to one particular risk in a platter in a single para. You even have to search for the figures which relate to this risk of material misstatement, which might be given in another exhibit. Financial statement numbers. You might have seen another exhibit. When you move on and when you reach another exhibit, you might find any interesting information which may be further strengthening this financial statement risk number 1. It may be paragraph number 10, in which you found a piece of information which is helpful for you to draft this pointer number 1. But no harm, because you haven't yet started drafting. You are the planning stage. And as you are reading the content, as you are reading the information, you can utilize that content in strengthening your planning pointers. Are you getting this? Can be withdrawn without refund if franchise conditions are not met. Can be withdrawn without refund. If the conditions are not met. If the conditions are not met, and if we find any information that conditions are not met, this could be an indication for the impairment. Very simple. These include the requirements to update fixtures and fittings as required by perpetual cars, to ensure a consistent brand image, and to meet certain customer service and sales volume key performance indicators. Providing these requirements are met, so is this a business risk? Okay. Is this a business risk? I feel this is a business risk. This $8,000, I see it as a sunk cost, expense if the conditions are not met. And it may have a negative impact on the operations. If the franchise agreements are cancelled, locations are gone, how are we going to sell it? How are we going to increase our revenues? Are you getting this? Providing these requirements are met, it is customary for franchise agreements to be renewed automatically after the initial 10 years period. Okay. So these are the conditions. Okay. Providing these requirements are met, it is customary for, if these requirements are met, then the franchise agreement will automatically renew. Historically, Calabrico has always had franchise agreements renewed, and as such have determined it is appropriate to capitalize the upfront fee and assume the assets of an indefinite life. Again, there's a question mark, because if the franchise agreement lasts for 10 years, and if there are indications that these are not going to be renewed, then these should be amortized over the period of its useful life, 10 years. Are you getting this? So, the indefinite, this treatment is not making sense here. Are you getting this? This is not making sense here. So we have to challenge this. So Perpetual Cars owns the Perpetual Car Co. owns the car showrooms, which are then leased by Calabrico for a fixed duration of 10 years. If franchise is withdrawn by the manufacturer, Calibrico will pay a penalty fee to exit the property lease early. Each showroom location is treated as a separate cash generating unit. Okay. So each para is enriching you with lots and lots of information about the business risk and the financial statement risk. Okay. Here you can find business risk and financial statement risk relating to impairment, recognition, okay, of intangible assets. Here you are given the financial statement risk relating to leases. Are you getting this? So those car showrooms which are then leased by the Calibri for a fixed duration of 10 years. So what they do? The Calibri Co lease the car showrooms from Perpetua Co. If the franchise is withdrawn by the manufacturer, Calibri Co will pay a penalty fee to exit the property lease early. If they exit before 10 years, they have to pay the cancellation fee. Each showroom location is treated as separate cash generating unit. Calibrico customers can part exchange their old car and receive an allowance against the cost of a new car at Calibrico locations. These part exchange cars are then serviced and sold as pre-used vehicle. Okay, let me see one thing. I said something relating to okay, that'll be exhibit 4. So is this a business risk that lease might be early terminated? Business risk? Okay, just hold on. Lease cancellation. Lease cancellation, if occurred, if happened, then they may impact the loss. They will result in the loss of the location, loss of that location, and loss of location means loss of customers, loss of revenue, loss of sales. Okay, so this is one aspect of the business risk. Are you getting this? Lease cancellation. If the lease gets cancelled, from where the company is going to do the business, or even if one lease or two leases are cancelled, it may impact negatively on sales. Our customers will be lost. Are you getting this? Then comes with this business risk. Don't you think that the financial statement risk of leases appears in? I think they get it leased. Yeah, the location is leased with all the furnitures and fixtures. And for how much year? 10 years. So, IFRS 16 criteria will be applied on it. This lease will be capitalized, obviously. Okay, so here comes the financial statement risk. Okay, so what we're trying to write, each should be a separate CGU, lease, I'm hinting you, I'm simply hinting you that how you're going to fetch the pointers. How you're going to draft it, we'll see it. Calibrico customers can part exchange their old cars and receive an allowance against the cost of new cars. These part exchange cars are then serviced and sold as pre-used cars. Okay, then service and repair options. Okay, so I'm moving a bit faster because you have already read this question. So I would be more interested in sharing the solution, the drafted pointers. So that I can show you how you're going to actually draft it. Okay, so I've already told you that you have to think or you have to identify the business risk and the related corresponding financial statement risks. Okay, for example, lease of outlet locations. Business risk if leases are cancelled. So what's the business risk if leases are cancelled? Loss of revenues. Okay, loss of revenues, loss of cash flow, and obviously decreasing all three indicators will go red. What's the risk of material misstatements? Risk of wrong or risk of improper and what is the requirement? Everything should be done as per IFRS 16. So business risk, financial statement risk. Then there is some other information which may give you another business risk. Calibre operates a car service and repair facility at each of its showroom. Repairs are carried out in a motor vehicle workshop and large amounts of car parts are held in inventory to enable repairs are made in a timely manner for customers. Customers have the choice to pay for the manufactured approved parts or opt for the cheaper generic vehicle parts. So mounting such an inventory, large amount of car parts, okay, repairs are carried out in motor vehicle workshop and large amount of car parts are held in inventory. Are you getting this? Repairs are carried out in motor vehicle workshop and large amounts of car parts are held in big inventory. Cash flow is stuck in the inventory. Large amount of inventory is piled up for the customers. And what if they get obsolete? The new technology, isn't it? So amount stuck in a stock, it may become useless of the change of technology. So obviously you have to take better decisions. Okay. Customers have the choice to pay for the manufactured approved parts or opt for a cheaper generic vehicle. Customer has the option. Okay, so these are the projected numbers. Okay. So for use, okay, let me use the calculator. So revenue has increased. By around 4%, if I've calculated correctly. Yeah, by around 4%. So revenue is up by around 4%. In PBT, have year-on-year increased by 14.4%. Expected to be increased. Benchmark is profitability. Materiality benchmark is profitability. Okay. The new car sales represents 70%. Okay, so there has been a new car. There has been new cars, which represent 70% of Calibrico projected revenue for the year ending 30th September 2025. And obviously there are still 3 months because we are standing on the 1st of July, as I already told you. At present, Perpetual Car do not have any range of electric cars. However, they're planning to the release the first electric cars in the market in 20X8. Perfectly fine. Okay, so failure of having sufficient electric cars. Don't you think this is again a business risk? Because we may lose our orders. Sorry, not bringing in various ranges in electric cars. Okay, plus new cars represent 70% of the projected revenue. What if the new cars do not work? Business risk. What if this revenue is not generated? Business risk. Impact on cash flows, impact on profit, impact on cash flows, new car sales. Because yeah, if the new car sales do not happen, our projected revenue will decrease, profitability will decrease. Okay, so you have to make a link of every information with the profitability, with the cash flows, with the revenues. Getting this? Okay. Loss of franchise location. That's something tough. Perpetual Carco has provided Calibri with a notification of their intention to withdraw franchise rights at one of their locations. Problems. Calibri Co. obtained a franchise. So we already discussed that if these locations are closed, this is a business risk. This is a business risk. And what disclosure will it require as per the requirements of 37? IS 37 relating to business closure, outlet closure. Can you book estimated costs? Can you book estimated provisions? No, you cannot. And if they're intending to withdraw the franchise rights from one of the particular location, then don't you think the intangible there will need to be tested because it's time for impairment? The agreement is getting cancelled. Don't you think the lease liability will also be affected relating to this? So all of these elements need to be included in your answers. Okay, so I'm quickly moving. Sorry, I skipped one para because unfortunately I'm not having a cup of tea. With me, and therefore, okay, loss of franchise location. I think I haven't read it completely. Calibrico obtained a franchise right for this location on 1st of October 20x2 and has failed to meet sales targets required by the Picho cars, resulting in the revocation of agreement. The franchise fee of 800,000 is non-refundable, plus there is a penalty. So should the penalty be recognized? Requirements of IS 37. So lots of business risks there, because obviously loss of location, loss of customers we have already written, but this penalty, again outflow, again expense, impact on cash flows, impact on expenses. Are you getting this? This is business risk. What is the financial statement risk? So we simply say, and we can simply say, ROMM will be that whether this is price 37. Provision are you getting this? How this is this penalty need? Does this penalty need to be recognized? Amount is there. Is it probable? Has there been an obligating event? What is the obligating event has already occurred? Okay. And it's probable as well. Book the provision. Are you getting this? Other assets at this site include furniture, fixtures, used cars, parts. The finance director of Calibri has stated these assets will be utilized at other sites. No adjustments have been made to projected FS. Okay. Stock inventory pile up, that's another business risk. Okay. Potential future listing. This is very important point because the entity is not yet listed, but they are planning to list in the future. Calibri Co. has decided to obtain a stock listing and is hoping for the initial offers of the shares to be made during the 6 months. Okay. Listing results in risk of management biasness, because obviously in order to list you have to see things good, rosy picture. Okay, so what happens is that there is a risk whenever there is a potential listing, there is a risk, inherent risk of management biasness. That management may going to tamper the results, change the results. Why? To make the financial statements look good, so that there could be sufficient investments when we are going for listing. Are you getting this? Lots of requirements need to be complied. Corporate governance requirement needs to be complied with. The prior data needs to be submitted and things like that. Okay. So I've explained to you the financial statement risks. With this in mind, the board of directors is keen to ensure that FS to show a strong. Okay. See this. The board of directors are keen to ensure the financial statements to 30th September 2x5 show a strong performance for the year. So they are keen to show the strong performance. They're keen to have their entity listed. So the risk of management biasness, they can play with the numbers, they can make changes to the disclosures to make it feel more lucrative. Okay. Okay. Then there is another information given, which is about audit committee and internal audit. Now let's see this. Audit committee and internal audit. In order to improve the company controls prior to the listing, Calibrico recruited newly qualified accountant with experience in external audit in April 2005. So again, there are two things. One is business risk and the other is yes, Michael, we will be explaining more on leases. I'm simply telling you how to plan. Are you getting this? Then we will be moving on to the drafting thing. I'm telling you how to plan and then we'll be moving on to drafting. Okay? So I'm simply saying if we talk about the business risk, lack of, or you can say poor, don't write like poor, I'm simply trying to make my point. Poor corporate governance. Okay? This is a business risk. Poor corporate governance compliance. Or you can say failure to comply corporate governance requirement. Okay. This is just a planning pointer, so no worries. Okay. The newly aims to create an internal audit department and hopes that by 31st December that this will have 2 full-time staff. In addition, Calibri has appointed 2 independent non-executive directors from the car industry and intend to have recruited make it an audit committee. There is neither the non-executive directors appointed there is any financial experience or expertise. So again, this is a business risk. So in this poor corporate governance compliance, these are the separate pointers. Internal audit department lacking internal audit experience. Non-executive the directors new appointed 2 non-executive directors, but none have the financial experience. Okay, so both of these first of all should be written in business risk and then their implication. Okay, what could be the implication? Problems in potential listing, poor corporate governance requirements, external internal audit staff has been hired who has experience in external audit. Problem. then none of the non-executive directors have the financial experience or expertise. At least one should have. They don't have. This also brings the concern to the control risk, control lapses. Control lapses, yeah. Control risk. Because if the non-executive directors do not have financial expertise, financial experience, then obviously for the financial reporting related controls might be compromised. Oversight might not be that strong. Oversight of the directors. Are you getting this? Okay. So having discussed multiple aspects, because we have already discussed many, so I've already tried to break down some business risks for you. Okay. Whatever the business risk is, obviously this needs to be explained well, and its implications should be explained well as well. Impact to cash flows, impact to profitability, impact to revenue, whatever the case is. So corporate governance, if we talk about corporate governance, so weak corporate governance is structure. Okay. Absence of adequate non-executive directors, lack of internal audit expertise, lack of financial experience. Impact, what is the impact? The decision making at board level, poor. There could be potential inefficiencies and decreased profitability. Okay. So these are the bullet pointers, but obviously you will be writing in the sentences. I have broken down these into bullet pointers so that I can explain you easily. But obviously you can write it in one paragraph. For example, absence of adequate non-executive directors and lack of their internal audit and financial expertise may impact the company as their suboptimal decision making at the board level could lead to potential inefficiencies and decreased profitability. Are you getting this? So you can merge it. This is one argument, but I have broken it down so that I can show you what's the problem, what is its impact, how you can link it to the cash flows, revenues, and profits. Are you getting this? Even this is linked to the operations, profits, and revenues. Inadequate non-executive directors. New directors lack financial or business expertise. Okay. Internal audit expertise is also missing. Financial expertise is also missing. Okay. Then we have internal audit team. Inexperienced internal audit team. Newly qualified accountant without prior internal audit experience. So obviously he might not be in a better position to oversee controls. So ineffective controls, higher risk of fraud and operational efficiencies, which could lead to loss of revenue, and because if he is unable to check and keep proper check and balance, that will result in losses, oversights, control lapses, and leakage of profitability. Are you clear? Then potential stock exchange listing, risk of management biasness, governance structure not aligned with the listed company listed standards, impact difficult attracting investors, limiting capital raising opportunities, cash flow problems could be there in listing. Okay, so this poor governance can not only result in the lack of control and lack of expertise and lack of oversight. No, this is one of the business risks. But what is another business risk? That this may lead to the failure of listing. This problem may lead to the failure in listing. Because when you're going to list, you have to demonstrate that you have met corporate governance requirement properly. And if they go for a potential stock exchange listing, then there are very much costs associated with this listing process. So higher costs during and post listings without guaranteed revenue increases. So what could be the impact? It can impact profitability due to increased operating expenses. Simple. Loss of franchise rights. Dependency on perpetual cars. You've already made this point. Reliance on a single franchise for sales and branded parts. Impact. Loss of franchise rights. Major revenue stream disrupted. Going concern issue. Loss of customers. If leased premises is gone, again, if any of the leased premises is cancelled, gone, loss of customers, loss of revenue. Are you getting this? You have to write it properly. Market reliance on new cars. Okay, so new car sales are highly dependent on economic conditions. Okay, so there's discussion of new car. Okay. So you can go through this. I'll share the solution, but the main purpose of discussion is that you get to know that how are we going to draft the business risks. Are you getting this? And you will also need to make use of the numbers to calculate ratios for explanation. Are you getting this? So lots and lots of business risks, and these are the elements which make a risk juicy, tasty, yummy, so that you can score maximum marks. For example, governance and structure. The impact which you have written, the impact, that's important. Suboptimal decision making at board level, potential inefficiencies, decreased profitability. Inadequate non-executive directors, limited oversight, challenges to the EDs, increased risk of poor strategic decisions. So the point is, you have to think of the problem and you have to think from your minds how it can impact revenues, cash flows, going concern, profitability. So 4 things. Are you getting this? So I hope business risk is crystal clear to all of you. Is it crystal clear? Please confirm me. Okay, so what I told is business risk is usually of 2 marks, but if you also include the relevant ratios for the analysis with the given content, with the given information, it may be 3. Usually it's 2, 2.5. Getting this? Marking scheme is very important. You should go through the marking schemes as well. Okay, so dear students, I give you 5 minutes. Draft any one financial statement risk, whichever you wish. Draft any one financial statement risk properly. Materiality, linking, area, accounting principle, accounting application, over statement or under statement, all elements. I'm giving you 5 minutes. Write a risk completely. Whichever you wish, you can write properly. Actually draft the risk, any one risk. Be it leases, be it intangible assets, be it any financial statement risk, be it the control risk of lacking corporate governance. Draft at least one financial statement risk, and I might ask you to show me by sharing your screens. Your time starts now. We'll be back in 5 to 10 minutes. Draft at least one financial statement risk. 5 minutes. Just take 5 minutes. Okay. So, dear students, If we talk about financial statement risks, how are we supposed to think? First of all, if the numbers are given, we have to see whether it is crossing the materiality or not. First of all, we have to check the number and we have to comment whether it is material or not. Okay. Then, okay, these are just bullet points. These are just bullet points, just to give you an indication that how are we going to think, the thinking pattern. And then we are going to discuss the detailed drafting tomorrow. I'll check what you have written on the comments. I'll give you the feedback. Adil has written one. For a season, there is really arrangement. Lessee needs to capitalize and depreciate and to account for the lease liability and consider the appropriate discount. There is the risk that FIR 16 arrangements not recognized correctly, leading to understatement depreciation. Present value of the payments. There is the risk that IFRS arrangements not recognized correctly, leading to risk of inappropriate disclosure or risk of recognizing the lease liability. Okay, so okay, you've written it, okay, fine, but one thing you should note here as well. One, that this is the risk, but you can maximum score if there is no amount given. If you cannot calculate materiality, then you can maximum score 2 marks out of this risk. And use these risks if there are no obvious risks available. For example, there are few very obvious risks available. Which one? Impairment. Which one? Losses. Termination of leases. Losses. Penalties. Penalty of cancellation. Very obvious risks which the examiner wants you to explain. Are you getting this? This is the basic one. The lease might not be recognized. This is the basic one. I'm not saying this is not a risk. This is the risk. But this is the basic one. Pick those which the examiner is hinting you that these are the risks which you need to focus on. Are you getting this? So you've written correctly, but I'll say that this is a bit remote risk. Okay. So impairment of assets. Franchise withdrawal triggers impairment indicators of assets. All the assets, okay. And impact, the assets will be overstated if the impairment review is not performed. Okay. Franchise fee. Indefinite life for franchise fee, not appropriate. Overstatement. Required review not performed for the franchise fee. Misstatement of intangible assets and expenses. And obviously, if the amount is involved, you can calculate materiality. Okay? Okay, just hold on for a second. Provision for early franchise termination. This one, obviously. You'll check it with the materiality if it's material, but if not, it should be disclosed at least. Okay? So, this is how you're going to draft, how you're going to make the pointers, and then we will see tomorrow that how this is actually drafted. Unfortunately, we will keep the session till here. We will not prolong it today. Apologies for the inconvenience. Because I was engaged in back-to-back meetings today. Therefore, the session was delayed and currently I'm feeling a bit tired. So it's better to continue the session tomorrow. I'll communicate you the timings, okay? Because we have not done much of the practice yet. So we'll try to have few hours tomorrow, and most probably, if required, on Monday as well. Okay? Okay? Okay. This one, termination provision. Termination provision. Okay? This is the termination provision. IS 37. The closure of outlet, the penalty of cancellation, 350,000, which we discussed in the question, it relates to that termination provision. But that might be immaterial. When you will calculate, it will come out to be immaterial, as far as I can recall. So recheck it, recalculate it and recheck it. Okay. So I'll let you know the timing tomorrow. If not tomorrow, then on Monday we will meet to discuss it further. Thank you. Take care a lot. Bye bye. Allah Hafiz.